The broadcast is now starting. All attendees are in listen-only mode.
Okay, so we've started the broadcast for the over-under billings and the WIP. We'll get started here in about 4 minutes, and hopefully more people who signed up will be able to attend. Well, it's time, so let's get started. It's 2:30 Pacific.
Okay.
It looks like we've got a small group today, so we can just go, and if more people join, they do.
Great.
So what I'd like to do is introduce Michael Kelly from Silvertrek, who is the president of Silvertrek, to the over-under billing and the WIP. It's work in progress for the everyman. And this is an excellent overview of work in progress. And Michael, take it away.
Awesome. Thank you, Phil. Yeah, this is a brief introduction to the work in progress. This is designed to give you an introduction to how the work in progress works and why it's important. This is something for anybody who has to deal with construction accounting. We want people to understand this better, and I feel like that's something that's counterintuitive to a lot of people, especially people who've come up through the ranks in operations. I'm glad you guys could be here today. This is kind of a fun little seminar, even though it's short. Feel free and ask questions by chat. We should have enough time at the end to answer any questions, or as they come in. If they're pertaining to what we're talking about right then, definitely type them on in, and we can get them answered right away. It's always more fun when we get some good to the point questions from you guys. So Silvertruck Systems started in 2010. We are a construction accounting services firm, and we've been dealing with the WIP ever since. We know that this is something that is not easy for small companies to deal with, especially if their job costing systems aren't world class. But we know that also that this is not beyond the reach of anybody if they just understand a few core principles. So today, to start out, I wanted to talk about the theory of the work in progress schedule and kind of answer the question of why are we doing this? Why does everybody talk about the work in progress? I know that I have to do this, they'll say, because my banker or my bonding agent is requiring me to do this, or I know I have to do this because my CPA is requiring me to do this. But really, what's in it for me? What is this work in progress thing? So basically, the work in progress, this as a full system, it's an accounting method that matches your recognized revenue to earned revenue. So what we mean by that is that we're going to recognize the revenue based on your cost, and we're going to use the cost to show how much revenue you've earned. So done properly, though, it's more than just an accounting function. Now, first of all, and most importantly, it forces project managers to actually care about their job cost, to have accountability to their job cost and look at it once a month and prove that they understand the financial aspect of their jobs. You'd be surprised at how many project managers go through life just completely understanding their job from a gut feel and not really digging into the details and understanding or proving rather that they understand their jobs and showing that through consistent projections. So a work in progress requires accountability from project managers, and that by itself is the highest priority or the biggest advantage to doing a work in progress schedule. Second of all, it provides readable, valuable management financials. So management financials typically in the QuickBooks world it has a problem in that if you bill on the 31st or if you bill on the 1st, you have a very, very different picture of what your month looks like. Using the over/under billings, using a work in progress schedule, this makes these management financials, namely your profit and loss, it makes it so that they're readable and they're actionable. The management of a company, of a small company, construction company, can know whether they're truly making money or truly losing money, despite when or how they build. Finally, it is required by GAAP, generally accepted accounting principles, and so it allows banking and bonding agents and CPAs to actually look at your financials and say, these financials are up to standard. I know what I'm looking at. I can compare your financials to everyone else's. And oftentimes it's actually this thing that is requiring people to come to do a work in progress schedule. Although it's, in my opinion, the third and last priority on the list. The first is you want to have your project managers understand their cost, because human nature being what it is, if they understand their cost, it will improve. And if you're measuring something, it will also improve. So before I go on, how's my audio? Phil, everything good to go on your end? Okay, great. Let's get into the actual process here. So, a lot of times when people teach over/under billings, they teach the WIP, they get into a spreadsheet and they start showing the individual calculations. But before we do that, I want to talk a little bit more about the theory of this and show you how you actually earn the revenue based on your cost, how we match our recognized revenue to our earned revenue. So on this chart here, we have a couple of axes. And what we have is dollars on one axis, and we have time on the other. And what we're going to draw on here is a job that has projected revenue of 125,000 and a projected cost of 100,000. Let's see here. So over time, we're going to be increasing our cost, and over time, we're going to be increasing our revenue. So, for example, if as the project, from the commencement of the project to the end of the project, we're going to be starting at zero and accruing costs fairly regularly, cumulative, up to $100,000. However, our billing is not going to be nearly so nice. It's going to be much more jagged. The first billing is going to come somewhere along here, and then we're going to not bill anything for a time, and then we're going to be able to do a second billing possibly, and that might be our final billing, and the cost is going to continue to trickle in, and we're going to get to our $125,000 before we've actually gotten all the costs. And this here at the end of the job, we're actually going to be able to see what our profit is. However, sometimes by the time the end of the job is rolled around, it's a little too late. You can't really do much about this. You made $25,000, but that was last month, and if you had known you were only going to make $25,000, maybe you could have got an additional change order made. The over/under billing process is an ability for your project manager to say, hold it, time out. What am I going to make at the end of the job? That's not enough. I need to make some corrections now when we're halfway through it. So in order to make these kind of rational decisions, we have to add our earned revenue to this. And earned revenue says, well, if we're going to have $125,000 at the end of the job, let's just track the cost curve here from zero up to that line and say, here's how much revenue we should have earned at any given point in time. Now, at the end of a month, say month 1, we can calculate the difference between how much we've billed and how much we've earned at any given point in time. In this case, we've billed more than we've earned. At month number 2, you can see that we've earned far more than we've billed. Month number 1, we're overbilled. Month number 2, we're underbilled. Simply by calculating our earned revenue, the blue line, and comparing it to how much we've billed, the green line. So we're using the cost and the projected final revenue to calculate this blue line. So now let's go into a few terms here. How do these terms match up with what we see here on our job? This is our $125,000 job. So first of all, we have 3 different terms that are important from a contract perspective, 3 different terms that are important from a cost perspective, and then we have 3 different terms that are used only in the work in progress or the WIP terms. So let's start with the contract terms. And I'm going to start with the original contract amount and compare that to our projected revenue. So we're going to talk about the original contract amount and compare that to our projected revenue. So here on our on this page, we said that the $125,000 was what we thought we were going to make on this job at the end. That is also known as projected revenue. But at the beginning of the job, back in this time period back here, we said that there was going to be that we had originally signed a contract for something different, most likely, than $125,000, because anybody who's been in construction long enough knows that the change orders are going to come in and modify how much you're actually billing the client at the end. So we need to have a difference in our system to say, okay, well, what did I actually originally bid this job at? And maybe originally we had said we're only going to have a $115,000 job. And the original contract amount is the contract amount that we had at the signing of the contract. Original contract amount is the contract amount we had at the signing of the contract. The projected revenue is at any given point in time, what does our project manager, that is, the person who's in charge of the financial performance of this job, whether it's the owner of the company or somebody that's hired by the owner. The person who's responsible for the financial performance of this job, what do they think they're going to make at the end of this job after all change orders are signed and paid for? And that's the $125,000 that we see here. The difference, that $10,000 difference, represents change orders, both signed and unsigned change orders. The projected revenue is the original contract amount. So it's the original contract amount plus change orders. The third term that we need to know in order to calculate our over/under billings is our build to date. And that's represented here by our green line as it comes up. So you can see in our first month, we billed $40,000 and we billed the full $125,000 in our second billing there. And that was in the third month after the end of month number 2. And in month number 2 itself, there was no billing itself. At any point in time, no matter when we drew these dotted lines for month number 1 and month number 2, we can find out how much we have billed to date by just adding up the full amount that we've billed for this job. Bill to date is fairly easy to understand. Now, before I go on, do any of you guys have questions? Feel free to type them in into the chat, and I would love to answer them.
No questions so far.
Okay. And on the cost side, we have a similar situation going on like we did with the contract terms. We have our original estimate and our projected cost. And what we're seeing here at this $100,000 is our projected cost. This is what the project manager's best guess of what they're going to spend, the cost of this job at the end of the job. When I get all done, how much am I going to spend? Well, that's not necessarily what they thought they were going to spend when they originally signed the contract. When they originally signed this $115,000 contract, they may have thought that they were only going to spend $95,000. But when they signed that additional $10,000 change order that they're billing to the customer, they're going to spend an additional $5,000 to get that $10,000 change order done. Also, there's things that as you progress on a job, you have labor overruns or underruns. You have additional materials that you're going to be purchasing. You're going to you might have had a subcontractor bail on you halfway through the job, and you had to hire another one to get in there to finish the job out. There's a million different reasons why that cost projection back here at the beginning of the job was not accurate. And every month as you progress, you want your project manager to reassess and say, how much do I think that this is going to cost now? The original contract amount, the original cost or the original estimate is the estimate of your cost at signing. When you sign the contract, how much did I think it was going to cost? The projected cost is the original estimate plus change orders, so the cost of change orders plus standard changes. That's an N and a G. So projected cost is our change order costs plus our changes in like labor overruns and materials. And then our cost to date is simply our red line here as it progresses. In month number 1, at the end of month number 1, our cost to date is this line right here. And looking at this, we can see that our cost at this time was $20,000. And looking at this right over here, we can see that our cost at this time was somewhere around $70,000. And our cost was progressing as our job progressed. At the end of the job, we were going to have spent $100,000. So we need to have those terms. We need to understand those terms. And what's important is that within your company, you know what you're talking about when you ask a question of a project manager. And you say, well, how much? Because it can get kind of confusing. You can say, well, how much money are you making on this job? And they think, well, they must be asking me about the build to date. Well, actually, you might be asking them about projected revenue, or you might be asking them, what did you originally think this job was going to bill out. And there's, you know, the time frames matter here. Are we talking about the original contract amount? Are we talking about the projected revenue? Or are we talking about the bill to date? And using those same terms, having that common language, allows you to talk to your project managers with less friction. So skipping down to the WIP terms now, we can actually calculate here using these three terms and defining them our actual over under billings. So the first one is our percent complete, our cost to date divided by our projected cost. And percent complete, just so you know, actually can be calculated by a number of different things. But 95% of cases, customers use, or construction companies choose to use cost as a barometer for how much they've finished on a job. So our percent complete is simply our cost to date here divided by our projected cost. In other words, it's these two items here that we use to calculate how much we're done with the job, our percentage that we're done with the job. Month number one, we can see that our percent complete would be 20 divided by 100, or our percent complete equals 20%. Our percent complete at month number two would be 70 divided by 100, or 70%. It's nice when you're doing these webinars because you can just make up numbers, and then all the numbers are really clean. It's amazing. Just like in real life.
Just like in real.
And then we have the next thing that uses this percent complete, which is called earned revenue. And earned revenue, remember, is our blue line. Our earned revenue is our blue line that we drew on here, but we can mathematically calculate this by taking our percent complete times our projected revenue. So if we go back up here, we can take our percent complete at month number one, which was 20%, and we can multiply it by our projected revenue. Grab a calculator here. We can take 125, we can multiply it by 0.2 or 20%, and we can see that our blue line at the end of month number one is $25,000. $25,000. So our earned revenue here is $25,000. We can do the same calculation at the end of month number two, and we can take 125, multiply it by 70% or 0.7, and we can see that our earned revenue is 87.5. 87.5. Our blue line mathematically we've been able to calculate is 87.5 at the end of month number two by taking our percent complete, 70%, multiplying it by how much revenue we expect to get. Now finally, we can look at our the third term here, which is our over under billings. And that is simply taking the amount that we've billed, or our billed to date. This is the same as our billed to date here, and subtracting out our earned revenue here. So if we go back to our chart here, we can see that we are at the end of month number one, our billed date is 40, and we can subtract out our earned revenue of 25, and our over under billing number for the end of month number one is $15,000. Even I can do that in my head. 15,000 here.
So Michael, this calculation on the blue line, there are other ways to calculate, you know, maybe hours spent through a job, or amount of cost spent through a job versus projected. Why
Yep.
earnings? Why is the earnings done the way it is done?
Why cost rather than
why cost rather than hours?
Yeah, that's actually a really good question, Phil, because there's several different ways that you can do it. Man hours is one that we see. We also see unit based. So like if we have say that we have a contractor that is installing that is an electrical contractor that has a massive job replacing all the lighting in say a Home Depot, and they can say that there's 1,000 fixtures that I'm replacing, and in these 1,000 fixtures I have replaced so far 80 fixtures, so therefore I'm 80% done with the job. That's possible to do. The problem is that most of the time jobs are more complicated than that. Most of the time, your labor hours don't tell you the whole picture. Most of the time, your unit-based don't tell you the whole picture. So in addition to the fixture replacement, which is the bulk of the job, there's also 3 phases of the job that have nothing to do with fixtures. They're also, for the manager, they threw in kind of in a horse trade, they're going to run a line to the manager's office because he needs a few additional fixtures in that office. And oh, by the way, there was this extra work, underground work they had to do outside the building, where they had to actually rent an excavator and do some underground electrical work outside the building. That had nothing to do with the fixtures. It was just thrown in as part of the same contract. So cost becomes a good proxy for percent complete. In some cases, you can use other things. You can use, I had a excavation contractor that wanted to use the length of pipe that they had put in on one job as a percent complete. And we definitely see man hours often used as a percent complete. But whether you use cost or a different method, once you get your percent complete, in other words, once you get your 20% here and your 70% here, which maybe would be 21% if you were using man hours and 68% if you were using man hours, the rest of the calculations is the same. You take that percentage, you multiply it by your projected revenue to get your earned revenue of $25,000 here and $87,000 here, and then you compare that to your billing in your last step to get you over under billing. You compare your earned revenue to your billed revenue. You compare your earned revenue to your billed revenue to get your actual over under billings. Month number 1, we said it was $15,000, and in month number 2, in order to get our over under billings, our billings less our earned revenue, we have to take our billings, which remained at 40 because we hadn't billed that whole month, $40,000 less 87.5, and so therefore we have a negative 47.5, negative 47.5, or a $47.5 thousand underbilling. This is when you start talking to your project manager about possibly getting the bills in on time because cash flow kind of stinks. So whether most of the time we use cost, and cost travels well from company to company to company. Dollars are used by all companies, but units and man hours are not.
Makes sense. Thanks.
Okay, so after we've gotten this far, now we have to take this and we have to apply it to our profit and loss. Now we have to bring this to our assets, we have to bring it to our liabilities, we have to bring it to our revenue account and actually modify those using debits and credits and the over under billing general ledger journal entry in order to actually make this a complete process. But I hope that just from this short little presentation, you can kind of see why we're doing this. One of the things to think about here is that in the traditional method of accounting, we would have $40,000 of revenue in this month, 0 in this month, and the remainder of $85,000 in this month. 40, 0, 85. And a month over month, this month number 2 profit and loss would really kind of suck. It looks like you're just bleeding money, but you're not. It's just that you had to delay the billings for any one of a number of reasons. And the over under billings the figure actually allows you to capture that in the appropriate month. So remember that I said earlier, if we go up to the theory, that the first reason that we did this was it forces the project managers to look at their job cost and prove that they understand their jobs. That was this first number 1 reason that we do the over under billings. Well, in order for us to actually have numbers here to talk about, we had to ask the project managers, hey, Mr. Project Manager, how much are you going to bill by the time this job's done? They had to give us this 125. We also had to ask them, how much are you going to spend? And they had to give us this $100,000 because otherwise us in our ivory tower of accounting world, we have to use the original because that's all we have is what's on the original contract, what's on the original bid. And that's inaccurate. So we had to ask them, and they in turn had to prove to us that they truly understood this. If they were looking at it, it's going to improve. Second of all, we said that this allows for the management team to have readable, valuable management financials. That's what we're talking about here when we say that we don't want to see 40,000, 0, and 85. We want to see something real. We want to say, we want to base what's on our profit and loss based on our earned revenue as it accumulates, regardless of when the happenstance allowed us to bill. And then third, we said that it allows CPAs, bankers, and bonding agents to review GAAP financial statements. And so this says going through this process allows you to have a GAAP approved financial statement for you to be able to have confidence to turn it over to a CPA for them to be able to put a stamp on it and say this is a reviewed financial statement, and for you to get the access to credit that you need in the terms of a bond or in terms of a line of credit or perhaps a loan from a bank, a long-term loan from a bank. And within all of these things work together to make it so your jobs are more profitable, your company is more profitable, and you have more access to the financial markets than you would otherwise.
You know, what's interesting about this is as I'm looking at this graph, in month 1, my profit is really the blue line minus the red, which is 5,000. Then month 2, it's 7,500. Then at the end of the job, it's really the 25,000.
Correct, the cumulative.
As opposed to
well,
20.
The QuickBooks way would be 40 minus 20, the 40 minus 20, or you would show 20,000 here.
Yep, and then
0 minus 70.
Yeah, so you'd be at a loss of 70 in month 2. And then finally, when you get to the month 3, you'd have the 25. So as in QuickBooks or in a simpler system, it would look like you're running an erratic company as opposed to the way you're really running it, which is a nice, smoothly growing company.
Exactly. And when you talk to a banker and you say, oh, by the way, we're really erratic, but will you lend us money? It just somehow doesn't go over as well.
Well, they look past that.
So tomorrow we're doing an in-depth training. I hope that you guys who have been here would be interested in coming to our in-depth training. If you go to silvertrek.net/event, you can sign up for it there. This is a paid training. What we're going to be doing is we're going to take these, we're going to allow actually much more in-depth. There will be a lot more questions and answers where we'll be talking to you and expecting a reply from you. There's also a test that we send out at the end to make sure that you've actually been listening. No, not really, but to make sure that you've understood everything. And then if you haven't understood something, we want to help you afterward to get through that final piece, that least intuitive piece of possibly the debits and credits. But we also talk about the accounting side of it, and we go into how you actually post over under billing and how you would modify a profit and loss, how even in the QuickBooks you could take Excel WIP and you could modify your profit and loss to make it so that it was truly something you could use as a manager, or you can truly use this to create GAAP financials. This was an overview, an introduction. In the next one, tomorrow we're going to show you how, so you have the tools to do this yourself.
Sounds good. And by the way, to add to that, on Tuesday we're doing a job costing webinar, a free intro to job costing, 30 minutes, short, quick, to the point.
Which is a great webinar if you're looking at this and going, well, Michael, that'd be great if I knew 100,000 and 125, but I have no idea. Sounds like you might need to start with, let's get a job costing program in place so that we can actually find this kind of thing out. If you have any questions, you should be able to find us on the web, Michael Kelly, silvertrek.net, Phil at philbride.com, and Those are our phone numbers and our email addresses. Feel free to contact us for any reason whatsoever. We sure appreciate having you guys here. It's always fun to go over WIP and talk about it to people who care. And with that, I don't have anything else myself. Phil, any last words?
No, for the people that took time out of their busy day to attend, thank you, and hope you have a great rest of the week and weekend. Thank you.
All right. And if we don't see you again, Merry Christmas and a Happy New Year. Thanks.
Bye.